Welcome back to Real Estate Economics weekly webinar series. This week we're covering San Luis Obispo County. This is part 2 of 2, so if you're interested in this particular residential market area, please make sure you see both parts today. In part 1 we presented an introduction to historical conditions and brought those forward to year 2010. Now we're going to include some 5-year forecasts with some history back to about 1990. As we mentioned in our first section, this is a fairly small market area in terms of employment, housing, annual sales, that sort of thing. You can see here the total housing stock in San Luis Obispo County is presently about 118,000. It tends to grow fairly slowly, as we mentioned before, and is really positioned to enter a phase, or has actually been in a phase for a couple of years and is expected to continue a phase of very slow growth, not even 1% annually. You can see as recently as 2006 we had 115,000 total units in this particular market area, and only 10 years out in 2015 will we reach 120, almost 121,000. That's attributable to very slow building permits. As you can see in this particular market area, permit totals for both single family and condo multifamily have rarely exceeded 2,000. Really just in the time period from 1998 to about 2005 were permits over 1,500 on an annual basis. As you can see, from 2009 through about 2011, we're going to be under 500 permits annually in a market like this. In our first section, we addressed the point that the housing stock is not that fresh here. The average year built is about 1980 for single-family residences. So many of the homes built in 80 are facing some depreciation, some incurable items. Remodeling is common. But we're really not getting the type of housing inventory growth that a market like this would expect. Now, one of the things that's going to happen from a difficult recession, the Great Recession as it seems to be called now, and extended period of slow employment, is many people are going to be forced out of the job market who might otherwise have preferred to stay in. If you can see the most recent California unemployment data, California employment situation continues to degrade. We've lost almost 100,000 jobs in the past 2 months here. So California's got a long ways to go in terms of employment. These job losses have tended to be concentrated amongst older workers, highly educated professions in some cases, and well paid in many cases. These can be people with equity who are positioned to move to a retirement or pre-retirement area if they so desire, and cash out their high equity home, accumulated equity in the coastal areas or in the urban areas, and move out to someplace a little less stressful. San Luis Obispo would be a great source for that demand to show up. As you can see here, total employment in this market is barely peaked above 100,000 in 2005, 6, 7, 8, and has now dropped back down to about 96,000. If you recall, our physical area was really 60 miles from north to south, with several main cities, but not a real concentration of population here. So the work base tends to be pretty well distributed. Now, one of the things we've also seen in the past several months is this particular graph shows non-farm employment. We've also seen some softness in farm agriculture employment. There are many countries now importing fresh goods. If you see at Costco, the pineapple now comes from Chile, and the different products, tomatoes are common in Mexico, and the asparagus comes from South America. There are many countries competing in our agricultural markets. It's tended to push a lot of low-value crops out of California where there's water allocation difficulties, and leave us, fortunately, with high-value crops, but at the same time that has not helped the farm employment side, completely separate from the non-farm we usually evaluate in terms of the residential housing market. Here's year-over-year 12-month change. You can see we had a recession in the early 90s and lost some employment here. The military has offered fairly decent employment in some Central California markets. We had a good time period through the mid-90s And then in 2009 lost about 4,700 jobs, another 2,100 in 2010. Those are big losses on an employment base that's 100,000 in total, and we have very slow, generally weak employment growth going forwards. There's just so many headwinds to the job market now. Read the paper, you'll see it all, but this is it's going to take several years to recapture our highs here, and it's going to build relatively slowly over the forecast period. Let's talk about interest rates. As you can see, since 1990, mortgage interest rates have been essentially in a one-way direction down. Coming into 2010, there's a lot of reasons for this. Efficiencies in how mortgages were generated, the secondary market, and a whole bunch of things. You can see in 2008 we were about 6%, going to 2009 at 5%, and now 4.9% for 2010. That drop from 6% to 5% was government intervention. We're gradually thinking that the government's trying to move out of the market here, and that rates are going to be trending slowly higher over the next 4 or 5 years. There's actually a huge spread really at this point between 10-year treasuries and 30-year treasuries and what we're paying in the mortgage market. It's interesting to note that many European countries have far lower rates than you can acquire to get a home in the United States. Here's a map of Treasury yields. This is the interest rate paid on a 10-year U.S. Treasury bond going back to 1970. This shows the same thing essentially as the mortgage market with a much longer time frame. This is a huge trend down from the peak here, which had rates of about 16% on a 10-year basis. Now in the mid-2s, 2.5, 2.6% day to day at present. So you can see the direction of rates has only been one way. I mean, cycles like this tend to correct very slowly, tend to base out over time, and produce quite a bit of volatility as any direction change emerges. So we'll watch this quite carefully, but it's always difficult in hindsight to think, well, where have rates been over the last 10 or 20 years? And it's clearly been down. So how does that manifest itself into supply and demand for housing? This particular graphic shows the blue line, which is the supply. We've just been talking about how supply grows very slowly. We're in a period of extremely slow housing growth here from about 2010 through the forecast period. By comparison, employment fluctuates much more significantly. When economic conditions are good, businesses hire quite quickly and demand for housing accelerates. Conversely, during recessions, demand drops way off, and the green line falls below the blue line. As you can see, 1993 and 1994 were the big military-based recession in California. Employment dropped way off and then rebounded very quickly into the dot-com era in 2002 and 2003. What these changes in employment mean as they relate to the supply of housing is that there are times when the employment base is either far too small for the existing housing stock, which drives prices down, or employment is far too large for the housing stock, which tends to drive prices up. Now, in most cases, those numbers correlate pretty well and they don't get too overextended, and then subprime came along. We'll talk to that in another slide, but we'd like to point out here, you can see the sudden drop in housing as the recession came along, and now we're in a period at 2010 and through the forecast period where the demand for housing is less than the supply of housing, which leads to tremendous undervaluation for the housing stock. So the current housing is affordable, and it's really less demand than you might see during periods of normal employment due to the recession and lingering economic weakness. How does that measure into housing values? In most markets and over fairly extended time periods, this green line, which is the supportable median home price, and that's really a function of what are local household incomes and current interest rates. So we're factoring in income specifically to San Luis Obispo County and rates, interest rates specific to this market area. In many areas, particularly in larger geographic areas, the blue line and the green line tend to correlate very closely because you just can't get buy a home too much out of sync with what you can qualify for. That wasn't the case in this big peak in 2004 through 2008 when subprime let people get a much larger loan than they could ultimately afford. That, of course, led to strenuous overvaluation, as you can see in the median home price in blue, all coming really back to earth in 2008. Now, over the forecast time period, we've got median home prices below the supportable prices. People in this market with good job prospects will find homes tremendously undervalued, and we have a period of undervaluation that extends for 4 or 5 years, gradually correcting itself out about 2015. You can see the house price trends in this particular graphic. As of 2002, before the subprime thing kicked off, the values were in the 280s to low 3s, running all the way up almost to 600. Now we're coming back into the mid 3s with just gradual appreciation over the forecast period. Here's the 12-month price trends. You can see double-digit run-ups in this area from 2000 all the way through 2004, and another big jump in 2006, and the payback that we've experienced with the market disruption and recent recession. You can see the forecast period. We've got some decent appreciation. Most of this is caused by correcting the undervaluation on the ground as opposed to rapid job growth, but ultimately it is price improvement. I hesitate to call it appreciation because it's really not based on higher prices, but it's more of a correction of the undervaluation that's so widespread at this point. We like to talk periodically about lumber prices. For those of you who follow the news, today housing starts were reported as being up 10.5%. You can see this immediately manifest itself in lumber prices. This is framing lumber traded on the Chicago Mercantile Exchange. The right scale is the dollars per thousand board feet, 300, 270, 240. Today's contract was up a full $10, so that's about 4%. And you can also see the open interest, that's the number of contracts that are owned at any given time, has been coming up. There are seasonal issues here where people tend to build positions, but we think lumber will be a really good indicator of how strong or how true a market correction is, or a market improvement, positive correction, is for 2011, and we'll look to this repeatedly over the next few months. Let's talk about this area briefly. Employment growth, really regionally and throughout most of California, hasn't been lackluster just through the recession and the housing market correction, but we've had a decade of weak growth. Counties like LA and some other places have shown no net job growth for 10 years. We've pushed jobs off to other states and in many cases other countries, and that's not supporting our housing market. We like to talk to foreclosed homes because even as foreclosures build and there's all the discussion of distressed inventory, many owner-occupants are not interested in a distressed home. The people willing to go through that has been proven through surveys as being a fairly low number, very difficult. Few entry-level buyers, which are most dominant in today's market, are willing to do this. And if you go into a market and your neighbors are all going to leave their homes and get foreclosed or short sold in the next few weeks, that's a much less appealing situation than buying a new home, even if it has a price premium. We like this area for mature markets, although we think it's prone to be high-income retirement buyers. A lot of people who are looking for low-cost living environments are going to go out of state, not just for lower living costs, but it may be important in your retirement years to have a state with secure finances and fiscal conditions. In San Luis Obispo County, we've talked about how spread out it is, how there's a concentration of a few cities. There's some coastal activity and some larger cities in the center of the county, but it covers a wide area, and the demand in any given place might not be that huge. So we'd suggest, if you want to build here, to build a diversified program with a lot of spread in your house sizes, in your house prices, and to keep your initial land commitments in shape through rolling options or size of communities that you're taking on. Overview of what we do here. Many of you know real estate economics in our online products, residential market consulting, land optimization, and retainer services. This is our team. Many of you know Mark at the left. I'm John Mulville. If you have sales or marketing questions, please contact Judy. Duell or Sandy Rivera. Please join us next week for our next series on Southern California.